All right, welcome to The Explainer. Today we're going to unpack the business of Zaggle, a really fast-growing Indian fintech company that's making some serious waves. So, let's kick things off with a question. Have you ever wondered how massive companies, huge corporations, manage all their employee expenses? We're talking millions, maybe billions, in spending on everything from travel and food to paying vendors and handing out rewards. It's got to be a total logistical nightmare, right?
Well, this is exactly where Zaggle comes in. They claim to be the answer, digitizing and simplifying all that corporate spending. But their solution isn't just some single, simple product. No, it's actually this multi-layered platform. And that's what we're going to do today. We're going to peel this thing back layer by layer and see exactly how it all fits together.
Okay, so layer one, this is the foundation of their entire business. It's their software as a service offering, SaaS. This is basically the digital toolkit they give to companies to manage everything. And this toolkit is made up of three core products. First up, you've got SAVVE. Think of this as the tool that tames employee expenses. It uses AI to look at a receipt and an expense claim and instantly say yes or no, sloshing a process that used to take days down to seconds. Then you have Zoyer. It does pretty much the same thing, but for all the payments a company has to make to its suppliers and vendors. And finally, there's Propel. This one is all about powering rewards and loyalty programs for employees and sales teams. So how do they make money from all this cool software? Well, it's a pretty straightforward subscription model. It's just like your Netflix or Spotify subscription. Companies pay a recurring fee for every single user on the platform. And if you ever look at their financial reports, this revenue stream is what they call their software fees. Simple, predictable income. But here's the thing. A subscription business is great, but it doesn't usually lead to the kind of explosive growth we've seen from Zaggle. So what gives? Well, this brings us to layer two. On top of that software foundation, they built a really, really smart distribution engine. And how did they do that? They became India's #1 issuer of prepaid cards. Now, it is absolutely crucial to understand how these are different from a credit card. A credit card is spend now, pay later. Zaggle's prepaid cards are the complete opposite. They're load first, spend later. The company puts the money on the card before the employee can spend a single rupee. You can almost think of it like a corporate debit card, but, on steroids. And this smart card system is what creates their second big revenue stream. See, these cards are not just about convenience. They give corporations an insane amount of control. They can set super specific rules like, okay, this employee can spend 50,000 rupees on travel this month and that's it. Anything over that, declined. And here's the best part for Zaggle. Every single time an employee swipes one of those cards, Zaggle takes a tiny piece of the transaction. That income stream, they call it program fees. So what you end up with is this really powerful ecosystem where it's a win-win-win. The corporates, they get total control and tracking over every single rupee spent. The partner banks, they get a golden ticket, direct access to thousands of corporate clients they can then try to sell loans or other products to. And Zaggle, well, they get a scalable, high-volume revenue stream that makes their whole platform incredibly sticky. Okay, so we've got software fees and program fees. But now we get to layer 3. And honestly, this is the one that really changed the game for Zaggle. This is the layer that completely transformed their financials and just threw their growth into overdrive. So what's the big secret to their crazy growth and those soaring profit margins? Well, the answer isn't in those software subscriptions or the transaction fees we just talked about. Nope. It's actually a surprisingly simple business model that supercharges their revenue. And, this is the important part, their profitability. This, my friends, is where the magic happens. We're talking about their gift voucher business. So, that Propel platform for rewards? Well, companies use it to give their employees things like Amazon gift cards. And Zaggle is the one making it all happen by going to Amazon and buying these gift cards in absolutely massive quantities.
It's a beautiful, simple model. Here's how it works in 3 steps. Step 1. Zaggle buys the vouchers in bulk, so they get a sweet discount, let's say 10 to 15% off. Step 2, they turn around and sell those vouchers to their corporate clients at the full price, the face value. So step 3, they get to pocket that 10 to 15% difference as pure profit. Now, here's a little accounting quirk. They actually get to report the entire face value of the voucher as revenue. And that is why their revenue numbers look like they've just gone to the moon. And just look at the impact this had. Before the voucher business really took off, Zaggle's gross margins were hovering around, a respectable 18%. But after they made this a core part of their business, that number shot up to over 50%. It was a complete and total game changer for the company's profitability. So, okay, we've got this powerful three-layered model. It seems to be firing on all cylinders. So the question is, how's the company actually doing? And what are their plans for the future?
Well, if we look at the first quarter, it's pretty clear what's driving the bus. That Propel segment, the one that includes the high-margin voucher business, grew by a whopping 51%. That just shows you how central that piece of the puzzle has become to their whole story. And looking forward, their ambitions are, well, they're not holding back. Management is guiding for 35 to 40% growth for the entire year. But, and this is important, remember that number, because that's just from their existing business. That's just organic growth. Because here's the real kicker. They're not stopping there. The company has also signaled that they're planning some acquisitions, and that these acquisitions could tack on another 40% of growth on top of everything else. So, you do the math. This brings up a massive question. If everything goes according to plan, could Zaggle's total growth actually hit a mind-boggling 80% this year? I mean, that is just a huge level of ambition.
Okay, so what's the bottom line here? From an analyst's perspective, what does all this mean?
All right, let's break down the investment case. On the plus side, it's pretty clear. Their integrated, all-in-one model is a major advantage. The market they're playing in is absolutely huge, and after a recent correction, the stock valuation looks a lot more attractive. But you have to look at the other side of the coin. The risks are real. Their entire growth story really depends on them pulling off these acquisitions successfully. You've got the potential for more competition down the line. And of course, their business is sensitive to what's happening in the broader economy. But the core idea from the analysis really boils down to this. Zaggle is a platform business, and the scalability has, really just started. They already have 3.3 million users on that platform. That is a massive captive audience. So think about it. Any new product they dream up or any company they acquire can be instantly cross-sold to those millions of users. That's how profit growth can go from linear to exponential. And that leaves us with one final and I think really crucial question. Is Zaggle's integrated model the future of corporate finance, or will their super aggressive growth strategy end up being their biggest risk? They've built this incredibly powerful, multi-layered engine for growth, no doubt about it. But the key thing to watch now is whether they can actually manage all the complexities that come with that kind of ambition. And that's all for this explainer.